Assalamualaikum. My name is Muhammad SYAHMY bin Muhammad ROSZAIDI, and I will be presenting about financial risk in Islamic finance. A very important aspect in the stability and growth of any financial system, including doing Islamic finance, is financial risk management. In contrast to modern finance, the operation of Islamic finance is based on Sharia principle that forbid interest, or known as riba, too much uncertainty, or gharar, and gambling, or maisir. These are the principles that inform how Islamic financial institutions develop, measure, and manage their risks in their operation. Financial risk management in Islamic finance involves sharing of risks, doing transactions on assets, and following the ethical rules of investment, which translates to ensuring that the financial operation is in line with the economic activity, and that this interest is safeguarded. The concept of financial risk in the Islamic finance context is critical to understand in order to get a sense of how Islamic financial institutions can manage financial stability and at the same time adhere to Sharia compliant contracts and operation. Moving on to types of financial risk in Islamic finance. First, we have credit risk, which refers to the risk that a customer or counterparty fails to pay their obligation on time, leading to financial loss for the Islamic financial institution. For example, in murabaha financing, if the customer fails to pay the agreed installments, the Islamic bank will face credit risk, and this may affect its cash flow and stability. Second is market risk, which is the risk of loss due to fluctuations in market prices, including commodity prices, foreign exchange rates, and equity prices. For example, in salam contracts, where full payment is made in advance for goods delivered later, if the market price of the commodity drops, the bank may face a loss when selling it later. Third, we have liquidity risk, which happens when an Islamic financial institution cannot meet its financial obligation when they are due without incurring unacceptable losses. For instance, if many depositors withdraw their funds simultaneously while the bank's funds are tied in long-term ijarah contracts, the bank will face liquidity challenges. Next is operational risk. Operational risk refers to the risk of loss due to inadequate or final internal processes, human errors, system failures, or external events. An example is when there are errors in Sharia-compliant contract documentation or miscalculation in profit-sharing ratios in mudarabah accounts. Lastly, we have Sharia non-compliant risk, which is the risk of loss due to failure to comply with Sharia rules and principles in financial transactions. For example, if a bank unintentionally invests in a company involved in alcohol production, the income from this investment becomes non-compliant, leading to reputational damage and need for income purification. Then, the key characteristics of financial risk in Islamic finance that differentiate it from conventional finance. Firstly, asset-backed financing, which means that every transaction in Islamic finance requires tangible underlying assets or services, such as in murabaha or ijarah. This reduces speculative elements but exposes Islamic financial institutions to risks like asset price fluctuation and depreciation. Secondly, Islamic finance operates on profit and loss sharing using contracts like mudarabah and musyarakah. Here, financiers share the business risk with entrepreneurs, which exposes institutions to the actual performance of the project they finance rather than relying on fixed returns. Third, there is the prohibition of riba or interest. This means returns are tied to real economic activities and not predetermined interest rates, exposing institutions to market and credit risk based on the performance of assets and projects. Fourth, Islamic financial institutions face exposures to market and price risk because transactions involve tangible assets and commodities. This makes them susceptible to market price volatility and foreign exchange risks. The fifth characteristic is Sharia non-compliant risk. This is unique to Islamic finance, where any non-compliance with Sharia principles can lead to reputational damage, require income purification, and potentially result in financial loss. Lastly, Islamic financial institutions face liquidity management constraints due to the limited availability of Sharia-compliant liquidity instruments. This creates liquidity risks when managing short-term cash flows while ensuring compliance with Sharia. Next, the importance of financial risk management in Islamic finance. Firstly, financial risk management ensures the stability of Islamic financial institutions. By managing risk effectively, Islamic financial institutions can protect themselves from unexpected losses that may affect their stability and the trust of their stakeholders. Since Islamic finance involves asset-backed transactions and profit and loss sharing, effective risk management ensures that these institutions remain financially resilient even during market volatility. Secondly, financial risk management upholds Sharia compliance. In Islamic finance, it is crucial to avoid gharar, which is excessive uncertainty, and riba, or interest, to maintain the integrity of Sharia-compliant transactions. Poor risk management may lead to Sharia non-compliance, requiring income purification, and may also damage the institution's reputation among customers and regulators. Thirdly, financial risk management is important as it protects depositors and investors. Deposits in Islamic banks are often based on mudarabah contracts, where depositors share in the profit and risk. Effective risk management protects these funds and ensures fair returns that are aligned with Sharia principles, maintaining the confidence of depositors in the Islamic banking system. Lastly, financial risk management facilitates sustainable growth in the Islamic finance industry. By identifying, assessing, and mitigating various types of risk, Islamic financial institutions can allocate their resources efficiently and manage their portfolios prudently. This supports stable and sustainable growth while maintaining Sharia compliance, which is essential for the industry to continue serving the community effectively. In conclusion, understanding and managing financial risk in Islamic finance is essential to uphold Sharia principles while maintaining financial stability and growth in the industry. Unlike conventional finance, Islamic financial institutions operate within ethical frameworks that emphasize asset-backed transaction, profit and loss sharing, and the prohibition of riba and gharar. By recognizing the types of financial risks, such as credit risk, market risk, liquidity risk, operational risk, and Sharia non-compliant risk, Islamic finance institutions can proactively protect their stability and safeguard the interests of depositors, investors, and the broader community. The key characteristics of financial risk in Islamic finance further highlight the unique risk environment that Islamic financial institutions operate in, demanding careful monitoring and ethical risk management aligned with Islamic values. Ultimately, effective financial risk management supports sustainable growth, builds public confidence, and ensures that Islamic financial institutions continue to contribute positively to the economic development of society while fulfilling their Sharia obligations. That's all from me.